G'day, Internet. Max right here, and we have one of our favorite contributors to the channel here, Dr. Jeff Frost. Thank you, Jeff. Thanks for being here.
Hey, Max. I'm always happy to be on your show. Thanks for having me back.
So, what are we? We're hot on the heels here of a Fed meeting and things like that. Why don't you give us a catch up on what went down and what do you make of it all?
Yeah, so, regarding the FOMC minutes and then Powell's presser afterwards, it was basically as expected. I don't think there were any surprises. The only surprise would have been if he would have done something, but basically they paused, right, and did nothing. And so that's what the markets were expecting. The one kind of surprising thing is that they released sort of the dot plots of what Fed officials think they're going to do in the future. And it basically says that the majority of them think there's still two more rate hikes. So basically from a 5.25% Fed funds rate at peak up to 5.75% before 2023 is over. The markets initially took that as bad news and tumbled. And then as they kind of read through it a little bit more, I think they basically thought, you know what, I don't think that's real. I still think the markets think, both the stock market and the bond market, and we can talk about that a little bit, believe that they're done hiking. So why do I say that? I believe, I'm invested mostly in the equities market and Bitcoin, obviously the Bitcoin space, but I follow the bond market very closely. So what's interesting about the T-bills, so short-term treasuries under 1 year duration, the 1 month and the 3 month T-bills, and I'm looking at those right now, they basically haven't budged. So the 1 month just is sitting at 5.01% yield and the 3 month is sitting at 5.09% yield. Why does that matter? If the bond markets believed that the Fed was going to hike, like say at their next meeting in July, these shorter term T-bills yields, those should have jumped up to kind of accommodate that. So the fact that they're just plateauing here, they look like they're topping to me. They say at least as of today, June 15th, they don't believe that the Fed is going to hike anymore. That can all change, and I always like to throw that in there, right? So if some data comes in, maybe inflation comes in hot next month, maybe the PCE comes in hot, something like that, these things always can change. And I will say that the CME futures, the Fed Watch, they still believe as of today that there's a 67% probability of a 25 basis point rate hike at the July 26th meeting. So there's a little bit of a divergence there. The futures markets are saying one thing, the T-bills are saying another thing. I'm siding with the T-bills this time. I just think that once the government ever says that they're just temporarily doing something, it almost always turns into be a permanent thing. At least I've noticed that in my older age. So I think they're done. I think this Fed pause rally is real and it will continue on for a time. And I think that when you factor in things like liquidity and what that's doing, I think there are reasons to continue to be optimistic in risk assets in the near term.
Okay. Just looking at those treasury curves a little bit over here, all the longer dated stuff did seem to go up, which is I find interesting. So I think that the market generally, I mean, there's still a deep downward curve, meaning everyone's kind of thinking that they're going to have to pull but I'm surprised. A year treasuries is still over 5%. So people are thinking that they can keep these interest rates quite high for quite a while.
Right. Yeah, that's definitely a possibility. And so whenever you see the yield curve as inverted as it is, as you know, like that's saying basically that the bond market thinks that the Fed has gone too far with its policy. And at some point they need to change course. And so we'll see the yield curve invert again from this, deep inversion that it's in right now. It will steepen once the Fed admits that they're officially done and that they're going to start thinking about a pivot at some point. That's when you see the yield curve steepen back to normal again. But that also usually signifies that the recession is very, very close at hand. So lots of stuff to look forward to. I still say we have a big bill to pay. I still think there's a chance of a serious recessionary bear market ahead of us somewhere, but it's not today.
So help me understand. I'm just looking here, and as of today, on the short-term Treasury notes, we see the interest rate is a little bit lower, and that makes sense to me because if coming up there's going to be a higher interest rate, you want to be in the shorter-term stuff so that you can buy the longer-term stuff. Is that the reason that typically those interest rates should go up if the expectation is that the interest rate's going to go up?
Yeah, generally the short end of the yield curve follows the federal funds rate very closely, and that's because these investors, they can either park their money in these T-bills, these shorter term rates, and that's usually these big institutional investors that are really moving these kind of markets, or they can just park it in the overnight reverse repo market with basically no risk at all, but having a comparable yield. So right now the yield in the overnight reverse repo market is about 5.05%, and it's been that for about a month or so. Powell was actually specifically asked that question yesterday. Is there a chance that they will lower that rate in order to get people to pull money out of the overnight reverse repo market and to start trying to absorb the bond issuance, the treasury issuance from the treasury, because they need to refill the treasury general account, the TGA, that everybody talks about? And he said just kind of no to that. He said that's a tool they can use. They're kind of keeping an eye on it, but they're not planning on doing anything seriously with that in the near term.
So what are they saying? As of now, the Treasury is buying most of this new issuance.
As in
the Fed, I should say.
Right. So no. So technically, the Fed is not supposed to be buying the issuance from the Treasury. That goes out into the market, and market players are supposed to absorb that. We'll see how much capacity for that the market has, and that's another thing that we talk about net liquidity on here all the time. That's something that can basically cause net liquidity to contract, and when net liquidity contracts, that's generally negative for risk assets like stocks, especially tech stocks, things like that. And so that's what I'm watching closely, is how much tolerance does the market itself have for all of this issuance that's coming out. So far, it's showing that there is a lot of capacity for it, and so far the market is absorbing the new Treasury issuance. So we'll see how it goes.
Now, the depth of the inversion, let's say, was reduced. The shorter term interest rates came down, the longer term interest rates came up, and the depth of that inversion kind of reduced. What do you think the market is saying there?
I don't put a lot of stock into these really short-term moves. I just kind of wait to see, what the trend continues to be. So I still look at the 2s and 10s, and they're inverted. Man, they're inverted over 80 points still. That's a massive inversion, right? And the 3-month, some people look at the 3-month, 10-year, still massively inverted. 136 basis points as of right now. That's a lot, and that just signals there's still massive problems out there and underneath the hood. And again, to me, all that signals is that somewhere down the road, we still have this debt to pay. We still have this recession to face, probably a more harsh bear market in risk assets. And until it steepens again, until that corrects and normalizes, I think we're in the clear. We could actually still have a bit of a rally in these risk assets as long as the markets believe that the Fed is done hiking rates.
Gotcha. Sticking on the meeting, there was an interesting exchange. So Powell was asked about something. You kind of threw Janet Yellen under the bus. Do you know what I'm talking about?
I heard that
a little bit.
I couldn't even believe it. Somebody just specifically asked, is the debt load of America sustainable? And if it gets to be to the point where the markets won't absorb this excess debt, basically the U.S. needs to print money, so it needs to create more debt in order to pay the payments on the current debt, and that's just this spiraling, the debt spiral, as they say, and it's compounding on itself, and it's going parabolic right now, and that's not a good thing when your expenses are going parabolic. And they flat out asked him, will the Fed be there to buy the treasuries for this, out of control debt? And he just said that's basically, it is out of control. It's their problem, and no, we will not be there to back them up and to buy it. And then and he had a little bit of fire in his eyes when he said that, and I'm just slaughtering his actual quote, but it was to that effect that we don't have their back, basically. And then it just moved on to the next kind of boring question.
It was basically, this is the Treasury's responsibility. If there's a grotesque overspending under income situation, that's the Treasury's responsibility. Massively throwing Janet Yellen under the bus. And the Biden administration. But I mean, it's been that way. Since questionably since Clinton, but even before then, because that was a bit of a hoax when he reassigned the pension money and brought that in. But really, it's been deficits for decades and decades and decades. But everyone's been saying it's coming to a head, it's coming to a head, and then he's just like, "Yep, it's completely unsustainable, and it's the Treasury's fault, and we're not going to do anything." But do you think that's legitimate? I mean, is it possible for the Treasury not to pick up all that slack?
So it was very noble of him to say that. I loved it, the defiance of it. And we're an independent institution. We are not beholden to them. We don't do what they say. But here's what's going to happen is that at some point, the Treasury markets are going to get really unstable because there won't be enough buyers of this massive amount of debt, and the Fed will be forced to step in. So whether that's Powell at the helm or whether the next president, whoever that is, gets rid of Powell and says, look, we need somebody who's just going to be just full on, dovish, full on quantitative easing, full on ready to absorb and monetize our unpayable debt. To me, that's inevitable. It has to happen. Otherwise the system collapses. So he can be defiant all he wants, but when the system becomes unstable, he's going to flip on a dime, I think.
Yeah, I think that's the case. I mean, so help our viewers understand the challenge here. So if the Fed doesn't step in and pick up that slack and buy those treasuries, then what happens? Why is it so devastating? And what are the choices that they have? What are they giving up to get?
Right. So a few things to think about. If there aren't enough buyers, right, then the price comes down more, yields rise higher, because basically people are saying it's not worth the risk. I need a higher and higher yield in order to assume this risk and buy that debt. So the higher the yield on the debt, that's just more money that the government has to pay. The Treasury has to make payments on this debt. And if that goes from 5 to 6 to 7% because they can't find anybody to buy it, that means they have to pay a higher and higher and higher rate on their just massive, crazy 30-some trillion, and that's just, their official debt, 30-some trillion of debt that they owe. So that's very bad, and it can compound on itself and spiral out of control. That's the one thing to think about. At some point, if it gets to be where they don't have enough buyers acutely, that's where the central banks step in, and that's where they, whether it's foreign central banks and they're kind of all working in cahoots with each other, or just the Fed itself monetizing its own debt. That's what they do to stabilize the market, to keep prices stable. You'll start hearing Powell talk about things like that. If there aren't enough buyers, they'll start talking about market stability, and we'll know that's going to happen, right? There are things to look for. So the debt markets will figure that out. The high yield option adjusted spread, the OAS, those will start to blow out. That's the difference between treasuries and high yield debt. So stuff that's even way more risky than treasuries, than U.S. government debt, is like, triple C rated companies that have debt out there. And people are going to be like, look, if we don't want to buy treasuries, there's no way we're going to buy, junk debt, basically, or junk bonds. So we'll see that spread widen between those two. That's what always happens as we head into a serious recession or a bear market. So I'll be watching for that closely. By the way, there's no signs of that right now. In fact, it's getting narrower, that spread, meaning that people are becoming more complacent, more confident, and they're more less risk averse. That's how the current market mood is right now. So anyways, we'll be watching for that. I'll be listening for Powell to talk about that. We'll know when it happens. Stock markets will probably tank and panic if that were to happen, and then that will be the beginning phases of ushering in the next wave of quantitative easing.
Yeah, right. So let's flesh that out a little bit more here. So we talked about the government's current, let's call it the admitted obvious debt on the books right now is around 30 trillion. But then in order to get elected, politicians like to promise things, but then they still want to get elected, so they don't like to increase taxes. So they have a whole bunch of what's called unfunded liabilities. Guesstimates in the range of about $200 trillion. They're promising pension plans over the next 30 years. They're promising welfare. They're promising all these different things, right? And so there's the funded liabilities, which is what we have, the $30 trillion debt. But then there's $200 trillion in debt in the unfunded stuff. And so as every month and year goes by, those things come to fruition and become real debt. The government have to print money in order to keep those promises. That debt skyrockets. And then this interest burden just gets higher and higher and higher. So you can see very, very quickly that even small movements in that interest rate changes things dramatically. Now, here's something that I get a question a lot from people. They're like, okay, you're talking about these markets, and then in your explanation there, you said, well, it's not worth the risk. So, the price comes down and interest rate goes up. But then people hear that, the Fed have these meetings and they just tell us what the interest rates are. So which is it? Does the Fed tell us what interest rates are? Does the market sort of dictate the interest rates? And how does that interact together?
Yeah, so both. So basically the short end of the curve, the 1 month, 2 month, 3 month, those kind of T-bills, treasury bills, those follow the Fed, what the Fed does. So the federal funds rate, that's closely paralleled by the short end of the yield curve. As you go out in duration, 1 year, 2 year, 5 year, 10 year, 20 year, 30 year, those are more market dictated. So basically, the Fed doesn't control the long end of the curve. They have strong influence over the short end and basically no influence over the long end of the curve. So that's why you see that huge discrepancy. That's why we see this huge inversion going on right now. While the Fed is being super hyper aggressive and hyper focused on getting inflation down per their mandate as they see it, the long end of the Treasury curve is saying, you know what, we think that if inflation won't be that much of a problem, 5, 10, 20 years from now, we think the bigger problem is growth, and we think growth is going to be very low and stagnant, and that's not good. And so when you see that inversion, that's not a good policy. It's basically the Fed is tightening into an economic slowdown, and that is just not good for markets in general and market participants. So that's why I think there's going to be more pain to come when you look at what the yield curve is saying.
Okay, so let's slow that down a little bit. I wanted to stay on the topic of crypto for a little bit longer, but now we're off topic, and this is just too interesting to leave. So in our past conversations, you had a very similar outlook to me, which was choppy sideways 20. We're talking about the Bitcoin market here, and these are different things. So let's just talk about how they relate. With regards to the Bitcoin market, you're expecting choppy sideways 2023 kind of action, 24 a good year, 25 a great year. First of all, let's recap. Did I remember your thoughts correctly? These are for me to remember because they were exactly the same as mine.
Yep.
So that all kind of fits in. So now you're saying expecting recession, but how does it, and possibly some pain in the equity markets, but you think there's going to be some divergence here between Bitcoin and equities? Is that what you're suggesting?
Somewhat, and there already has been, by the way. They had been really closely paralleled, but if you've noticed in the last about 2 months or so, NASDAQ stocks have boomed while Bitcoin has basically been tanking or lagging, been pretty disappointing. A lot of that has to do with Binance and Coinbase and the SEC and all those kind of things holding it back, I think. And also just because there is a little bit of a discrepancy, I think people are finally starting to see a little bit of difference between the two. I will say, though, that again, to me, it always comes back to liquidity and what liquidity is doing. And so liquidity ramped up really high. It basically bottomed, and I'll just do a quick recap. Both worldwide and U.S. net liquidity basically bottomed into the fourth quarter of 2022, ripped higher, and risk assets, as everybody knows, basically sniffed that out, caught that bid, and they ripped higher as well. Then they peaked in about mid-March or so and came down pretty substantially until the end of April. But then, interestingly, as people started talking more and more about the debt ceiling and more about the Treasury general account needing to be refilled and how that would be kind of a net negative, a contraction to liquidity, actually net liquidity has been creeping higher since the end of April. So all throughout May and the first part of June, it continues to creep higher. It's kind of back to the mid-March levels right now. I don't know what it's going to do going forward. It really depends on what happens with the overnight reverse repo market, Treasury general account. Why do I talk about all this? It seems pretty esoteric. It's because there's a really tight correlation between liquidity and what risk assets do and what Bitcoin does. So either tech stocks, which I think are way overbought right now, they need to come down to kind of, to match what liquidity is doing, and or Bitcoin needs to go higher to get back to those levels too. The jaws will close. So right now there's this huge divergence. They need to come back together. Whether that means tech stocks need to come down or Bitcoin needs to go up, one of those two things I think is really likely in the next month or two. So that's how I'm looking. And why I think we're going to have sideways choppy is we just don't know what liquidity is going to do. But when I look out at with my crystal ball with liquidity and net liquidity here in the US, it looks like it's going to be basically flat to possibly a little bit higher, both in the US and throughout the world. And so likewise, I think risk assets in general are just going to be kind of choppy sideways.
Gotcha. And it makes sense to me. If you go back to 2021, there was so many speculators in the market, and hence Bitcoin tracked like a tech stock. But I think a lot of those guys got kicked out over 2022, and so the membership of the Bitcoin Union, if you will, very much is like the long-term thinkers right now. Compared to, obviously there's a mix of both, but compared to those guys, compared to those times, you'll see a lot more. Long-term Bitcoin is in now, strong hands, diamond hands, and as a result, I would expect it to not track quite as closely as the equity stock. So it makes sense that you get that divergence in my mind. If equities are going up, then the long-term thinkers are like would go the opposite direction. Let's talk about Binance a little bit. You mentioned it. What's going on there? Have you been following it?
I have been. I mean, I'd like to make it very clear. I'm not an attorney, right? So I don't have any even a legal opinion worth listening to. But what do I think is going on? The SEC is obviously going after them hard. I did read through some highlights of what the judge had to say about it, and basically the judge was kind of telling the SEC a little bit to cool its jets a little bit, and work together with the Binance team. You know, they had this TRO put out there. And the judge was basically like, you're being a little extreme. All we want to make sure is that you're not going to let the $200-some billion that are sitting in Binance.us to get to flee the country. We want that safe for American investors, basically. And Binance agreed to that, and so they're working through some things here initially. It sounds like they want to push the case through quickly. To me, it sounds like the most serious issue is that CZ is being allegedly has over 100 kind of separate businesses that he's been kind of transferring assets to and from, all overseas. That are obviously very nebulous, hard to track down, and confusing, and regulators like the SEC don't appreciate those kind of setups, and so that's why they're coming after him pretty hard, and they want this to happen very quickly. So it sounds to me like that's the main issue of this case, and I would say that Binance looks to me like it's in trouble. Will it be the same organization? I would say very much no. It's going to be much smaller. There'll probably be no presence in the U.S. after this, but they may just go completely overseas as a smaller entity. And I would think that after the SEC is done with them and through this court case, that they will be a much less opaque set of operations. But we'll see. I think it remains to be seen, and it remains to be seen if the SEC. I think everybody knows exactly what the SEC thinks, right? They strongly believe that all cryptos, other than Bitcoin, for the most part, are securities. They think that both Binance and Coinbase are, operating illegally because they're allowing for the trade, buying and selling, and facilitating the transfer of unregistered securities. That's a grievous sin. But I think the point that the defense is making is that still hasn't been proven in the law that these are actually securities, and so could all be a moot point. So I think it's super interesting. And it is complicated, and it has a lot of ramifications for Coinbase, for Kraken, for everything else that could really change things up. Jeff, anything else you want to touch on before we sign off? No, other than it's just an interesting time. Like I said, I think that we could have a kind of a surprisingly nice summer here. I hope that Bitcoin can get. It feels like it's being dragged down. It's been oversold based on my technical analysis for over a month now. So I'm waiting for it to spit higher here any day. But who knows how long this could drag on for? It may just be kind of a summer doldrums as long as the SEC has these cases out.
Okay, appreciate your time. Thanks so much for being here, Jeff. Guys, comments and likes in the bottom. Thanks so much, and we'll see you soon.
Thanks, Max.